The S&P 500 has officially entered its first 5% correction of the cycle. By breaking below its 200-day moving average, the index is signaling a technical shift in regime. This breakdown establishes a defensive tone as technical failure meets emerging shocks in the AI and credit sectors. Our market map identifies two tactical hotspots currently breaking the technical trend. In the AI sector, a criminal indictment against Supermicro involving $2.5 billion in hardware smuggling has triggered a compliance shock across the supply chain. At the same time, we're seeing the first major liquidity test for private credit, with withdrawal gates at Blue Owl signaling stress in a market that previously lacked transparency. Beyond these specific disruptions, we're seeing a structural shift in the macro environment. The Fed has effectively reset the neutral rate to 3%, marking a formal end to the era of cheap capital. This hawkish turn is already impacting positioning. Data from NANA shows a second straight week of net outflows from U.S. equities as investors rotate into the relative safety of money markets. While we're seeing capital rotate out of equities, a more specific compliance shock is hitting the AI trade. According to reporting from Bella and Nana, a Supermicro vice president has been indicted for allegedly bypassing sanctions to ship $2.5 billion in AI chips to China. This hits the core of the supply chain. Since Supermicro accounts for roughly 9% of NVIDIA's revenue, these regulatory hurdles could create a direct drag on NVIDIA's short-term delivery schedule. Legal headlines continue to weigh on sentiment, yet the technical outlook for the sector leader is reaching a pivot point. With momentum showing signs of exhaustion, price action suggests a potential test of the $165 support level. This marks a shift from the initial regulatory event toward a broader repricing of the hardware space as the market adjusts for potential delivery delays. The $1.8 trillion private credit market is seeing its first real test. Patrick Boyle reports that stocks for major managers like Blue Owl and Ares have fallen roughly 40% this year. This decline follows Blue Owl's decision to block withdrawals from a private fund, highlighting the risk of withdrawal gates during periods of market stress. Much of this perceived stability comes down to how defaults are managed away from public view. Patrick Boyle highlights a Goldman Sachs study showing that 97% of European debt events are handled behind closed doors, effectively shielding their true scale. Beyond that, investigations have found billions in loans where software companies were creatively relabeled to obscure industry concentration, suggesting the low volatility in these portfolios is largely an accounting effect. We are shifting focus to a new set of risks, where geopolitics are driving a second wave of inflation. Reports suggest the U.S. is considering a blockade of Iran's Karg Island, which would put 20% of global oil transit at risk. For stock investors, $91 is the headline number to watch. Once oil crosses that pivot point, energy costs start to become a primary threat to equity valuations. While the immediate tension sits with crude staying above $91, the broader impact is moving into the agricultural sector. Higher fertilizer costs are already creating a path for price pressure to roll from the oil market into food supplies. To track this shift, Macro Voices highlights a call spread in the Tecrium Wheat Fund as a potential way to hedge against this next cycle. Starting with single-name signals, Adobe is trading at roughly 10 times free cash flow. While that valuation looks attractive, the channel is flagging a risk that recent growth may be driven by one-time AI upsells rather than a sustainable expansion of the user base. Meanwhile, Lululemon has seen its PE compress to 11, near a $15 billion valuation floor, as investors keep a close eye on a $300 million jump in inventory. In the growth category, Planet Labs reached a turning point with its first-ever quarterly profit and 41% revenue growth. But as these smaller names mature, the credit risk for big tech is also shifting. Microsoft, Meta, and Google were recently included in the CDX Investment Grade Index. This reflects a market that increasingly views heavy AI capital expenditures as a structural debt liability. Our final watch list focuses on oil as the primary indicator for equity survival. We're watching that $91 level closely. If energy prices stay elevated, it likely signals a worsening geopolitical regime. For value-oriented setups, Lululemon is approaching an estimated $15 billion floor, while the wheat ETF serves as a cue for persistent food inflation. Collectively, these signals suggest that the stability we're seeing in certain sectors today is more of an accounting artifact than a reflection of true market reality. The week ending March 20th confirms a structural shift into a more defensive market. With the Fed resetting its neutral rate to 3%, the macro backdrop has fundamentally changed. As we head into the weekend, we're watching the situation at Carg Island and its potential impact on Monday's open. You can find the full list of sources and claims in the video description. Subscribe for the next update.